So Tesla stock's been back in the news a lot lately with big changes that they're making and with their stock being kind of up and down. So we're going to do an updated 2026 analysis of Tesla and see where we're at right now. So Tesla stock is actually up over the past year, barely outpacing the S&P 500. And the reason I like to compare those is because you are trying to get, with no dividend from Tesla here, you are trying to get quite a bit of growth. And the only reason, to me, in my opinion, to invest in individual stocks is to outdo the index. The index is what most people would say is kind of just the gold standard, the safest way for you to invest long term. Just put money in the S&P 500 every month. Well, if you want to try and get better results, that's kind of the goal of this channel. Then you have to look and be very specific about what you are trying to get out of a stock and how are you going to beat the indexes. Well, Tesla doesn't give you any sort of dividend, and so you are trying to get maximum growth from Tesla. So you are looking to possibly buy or hold Tesla with the idea that they are going to give you a lot of growth and hopefully outpace the other indexes. So when you look at Tesla over the past 5 years, up 57.67%, you would have actually been better off with the S&P 500. That doesn't mean it's going to continue that way though. Now, if you look at the past 6 months, Tesla's up 22.52%. They did rally a little bit after Elon kind of got away from the political scene. But over the past month and over the past day, of course, they are mostly in the red. So they also missed on their most recent quarterly financials. So they were actually 3.14% off on year-to-year revenue and pretty much down across the board on net income, diluted EPS, and net profit margin. So obviously not what you want to see. As far as earnings, they did beat on 10.96% on EPS, and they beat by 0.49% on revenue. So revenue is very close, but some positives, it's not all negative. Now, some news about Tesla, they are actually starting to produce the cyber cab, as they call it, which is essentially a robo-taxi. It's possibly the future of transportation. It just depends on who's going to win this race and who's going to get the biggest market share. Waymo is looking really good right now. They're owned by Google. They seem to be testing more than Tesla right now in more cities in the US. So they are getting more permission to test in major cities. But Tesla is trying to get a piece of that pie with their cyber cabs, which are going to be driverless, fully automated, and electric. So they're trying to get a piece of public transportation and also compete with the likes of Uber and Lyft. So that's one thing they're doing. Now, we also have their discontinuation of models like the Model X and the Model S, which is going to be in the spring of 2026 as well. So some major changes coming in the spring. And that is so that they can focus on building the Optimus humanoid robot. So really betting on the future of transportation and betting on the future of having household robots. That's what Tesla is doing right now, rather than just sticking with regular personal cars. It's a bold move for sure, but it could pay off very well. It also could completely backfire. It's hard to really say right now. Now, to dive more into the numbers that tell you whether or not this makes sense from an investment standpoint and whether or not this is a good bargain for comparing, say, their stock price to their earnings to a lot of other things that we need to do some number crunching with. So a lot of things I like to look at here, and we're going to start with the PE ratio. The PE ratio is extraordinarily high. Like, I very rarely see a PE ratio that high for a stock. 375.43. A lot of people will be like, no, I'm not buying a stock until it's under 30 or under 20 in some cases. So theirs is literally 10 times that. So you're going to have to look at that and be like, well, I mean, obviously a PE ratio is just one indicator. It's not the end all be all, but that's not usually a green flag when you have that high of a PE ratio. Again, it's hard to justify that unless you are getting ridiculous amounts of growth. Now, a lot of tech companies do have high PE ratios right now. So we'll see how that plays out. But we do also have another type of PE ratio. So you can look at both forward and trailing PE ratios. So Robinhood uses typically a forward PE ratio. So theirs is a little bit different. The number is a little bit different from what you would normally see on Google Finance, which is typically a trailing PE ratio. This one is 388.17. So both of them are very high. Every once in a while, you'll see a big difference between the two. Most of the time, you don't. I also like to look at the past 3 months just because that is the equivalent of a quarter. And over the past 3 months, Tesla is up 2.82%. So as you can see, kind of had some nice growth, and then around the start of the new year, it's just been downward since then. Now, if we look more into their finances here, their return on assets and their return on capital are two things I like to look at. These two numbers are typically, by many standards, not good right now for Tesla. Return on assets and return on capital being quite a bit lower than what you would normally want. Typically something like 5 to 10% on return on assets. Anything above 10% would be considered usually strong. Return on capital, 3.05%. Normally you want something like 8 to 15. That's pretty bad as well. So obviously just a couple of minor indicators to keep in mind there. If you look at assets versus liabilities here, you are over a 2-to-1 ratio of assets versus liabilities. So at least that's good. Year-to-year change seems to be improving for those. And if you use something like Robinhood, you can also look at what customers are doing, just like average people, hedge funds, as well as insiders. So when you look at what the average person is doing, this goes on a day-to-day basis. For whatever reason, they separate this by different timelines. But on a day-to-day basis, it looks like a little more selling than buying right now during the last week or so. Hedge funds, sometimes I look at these just with interest. It doesn't mean I'm going to make a decision ever by what a hedge fund does, because a lot of hedge funds can't even beat the S&P 500. So as far as what hedge funds are doing, 62% buy, 38% sell. That's in Q3 2025. Q2, 75% buy, 25% sell. And then mostly selling Q1 2025 back during that big political storm that Elon was in. So a little bit of improvement here. Now, a lot of this might be partially because of ARK Investment, which is Kathy Wood, a pretty well-known person in the space. Pretty controversial decisions at times, not always the best returns, but sometimes she bets big and wins big. Sometimes she bets big and loses big. So it just depends on whether you agree with her philosophy on investing or not. But a big part of this, of course, she's bought 512,000 shares of Tesla recently over the past year or so. And then insiders is kind of interesting, but really doesn't mean much because a lot of insiders will sell a certain amount of stock like at the end of the year or at a certain time to take some profit. It doesn't mean that they don't believe in the company necessarily. But the most recent one was 60,000 shares being sold, and that was back in January 2026, so last month. Now, as far as what analysts are saying, so if you want to go by the consensus, you have 54 Wall Street analysts, and they have a hard time agreeing on what to do with Tesla right now. They say 42.6% buy, 40.7% hold, and 16.7% sell. That's not really the biggest vote of confidence that I've seen in stocks. Most of the stocks that I review are at least pretty close to like 60 or 70% buy, and much lower on hold and sell. So right now, barely split between buy and hold, and quite a bit higher sell rating than a lot of the ones that I usually look at. And you do have a fair amount of analysts as well at 54. Many companies only have a couple dozen ratings. Now you can also look at earnings. Obviously earnings are very important as well. You can kind of look at the trend over time. Are they typically beating? Are they missing? Are they raising guidance? Are they lowering it? So this chart makes it really easy to see this. That's one reason I like this one. If you look right here, for the most part, they were doing really well in 2024, and then they missed in two of those, though, of course, but they kept raising guidance. Q1 2025, they massively lowered expectations, and they still missed. And then they did beat expectations in Q2 by a little bit, basically met expectations Q3, and then slightly beat expectations Q4. And now we're waiting to see for Q1 2026. But they had actually, after Q3 2025, they'd actually kind of been lowering expectations. So that's not really the best vote of confidence either. Now, a few other numbers I like to look at. Again, none of these by themselves are an end-all be-all indicator. But if you look at, say, the PEG ratio, which is Another alternative is something like a PE ratio, just trying to get an idea of whether or not this is a good bargain right now or not. And forecast 12-month forward PEG ratio is ridiculously high for Tesla. It's been high for a long time, over the past year or two, especially when I've been covering Tesla. And 14.74, just to give you a comparison, typically you want something closer to like 1 or 2. And they have a 14.74. 1 being pretty good, like a bargain. And then once you start getting above 1 or 2, you're starting to say, well, maybe it's not the best price for them right now. And again, they are multiples above that in terms of a red flag. So not the best indicator there. If you look at their EV to EBITDA, another alternative to a typical PE ratio, their EV to EBITDA, which is more of a raw number, before you would get to something like a PE ratio, it doesn't have as many like loopholes that could be used to artificially make it look better through something like accounting or taxes or things like that. So with this one, if you look at their EV to EBITDA, it's currently 125.95. Again, very high. And then to put it in perspective, sometimes you don't want to just look at the number by itself. You want to look at how does that compare to the industry that this company is in. And right now it's ranked worse than 96.98% of companies, which is 1,160 companies in the vehicle and parts industry. Now you could also make the argument that, well, maybe they should be evaluated more like a tech company than a vehicle company. But, because a lot of vehicle companies are probably going to have generally lower EV to EBITDA ratios than a typical tech company, but they are a vehicle company that's trying to transition into kind of an all-in-one tech company that does both vehicles and solar roofing, solar batteries, as well as humanoid robots. So they're doing a lot of things now, and I'm not sure if they're going to be able to do any one thing well enough to really turn their stock around or not. It just really depends on what you believe right now. A lot of this, of course, is public sentiment. Another thing I like to look at, just as another small indicator that maybe their leadership is good or not, is what do employees say about the leadership at this company? It's one thing to have good ideas. It's one thing to have, good stock indicators. It's another thing to have your actual company, the people that you pay to work for you, believe in your vision or not. So if you look at this, they have a 3.5 out of 5-star rating. I would like it to be a little bit higher, but it's not like a deal breaker because that's not really super low. If you look at 57% would recommend working here to a friend. 57% is just above average, obviously, so they're fairly split there on what they believe about working here. And then 57% approve of the CEO, so just barely above average approve of Elon Musk. And obviously a pretty controversial person, especially in the past years too, when he got involved in politics especially. But when it comes to what his employees say about him, they're fairly split with slight majority leaning towards approval. So right now, for me personally, I would not get involved with Tesla, even though they are down a little bit. And you could make the case, well, buy the dip. I think buying the dip is generally not the best advice a lot of times because there have to be a lot of things that line up for you to really be like, okay, well, the dip is almost over. A lot of times you don't know when the dip is over. So trying to time the market is just something I generally don't believe in. I believe in buying really high quality companies, believing that they will be in a good position long term and not trying to time them all the time and being like, oh, well, it's dip today, we should buy the dip now. It's like, well, that dip could go a lot lower if you're not careful. I am not in on Tesla right now. I know Kathy Wood and her hedge fund are all in on Tesla, and I'm not trying to compare myself to a hedge fund manager right now, but if I'm trying to continue beating the S&P 500, I don't think Tesla is actually going to help me do that. If I had it right now, I would probably either sell it or maybe hold a little longer and see how this robo-taxi thing plays out. I think the vision kind of makes sense, but the numbers don't back it up yet. The returns have not been good on the stock. All indications are saying that they are way overpriced right now. And so really, you're just buying into the vision of Elon Musk. That's essentially what you're buying right now. Tesla, some of their vehicles have improved in terms of reliability over recent years, like the Model 3, so that's good. But they're also losing a lot of market share in Europe to China's EVs, and obviously getting more and more competition. I don't think they've had much success with their solar roof venture, so they have more and more EV competition They also make solar roof. They also do the whole solar roof and battery combination that used to be called Solar City. You never hear about that. They're discontinuing some of their vehicles to work on robots that we have no idea if there's going to be as big of a market as they believe for those yet. Also, lots of competition from other robotics companies as well. And then their next product that they're trying to roll out is the robo-taxi, which is going to have lots of competition from existing taxi services like Uber and Lyft, but also from a robo-taxi service from Google called Waymo that seems to be further ahead on testing in major cities. So for all those reasons, right now I am out on Tesla. This is not financial advice by any means. Everyone has their own investment philosophy. This is just mine. Maybe it'll make you consider a few things that maybe you didn't consider before. But please do your own research. Please consult your own financial advisor before making a big decision. And also consider your portfolio allocation and your long-term goals.